Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from WEX Inc., and trust me, it involves numbers so big they make my calculator sweat. We're talking about hundreds of millions of dollars, so it's a big day. WEX just made a bunch of financial moves, raising a lot of money and deciding what to do with it. It sounds complex, but we will break down what it all means. WEX is essentially restructuring some debt, buying back shares, and planning for the future. So WEX just finalized a big deal where they offered a bunch of new notes, which is a type of debt, totaling $550 million. Think of it as taking out a massive loan. They also amended a previous credit agreement, basically tweaking the terms of an existing loan to get an additional $450 million through something called an incremental term loan B3 facility. That's almost $1 billion move to start with. Now, what's WEX planning to do with all this cash? First, they're using $750 million to buy back shares of their own stock. This is called a tender offer. Then, about $250 million is going towards paying down some of their existing debts. The rest, well, that's for general corporate purposes, which could mean anything from new investments to further stock repurchases later down the road. Let's talk about these new notes a bit more. These notes are like IOUs, and they're governed by a formal agreement called an indenture. Several of WEX's subsidiary companies are guaranteeing these notes, acting as guarantors. This is to ensure that if WEX can't pay, these subsidiaries will step in. These notes and guarantees are senior unsecured, meaning they're higher up the repayment ladder than some other debts, but aren't backed by specific assets like a house is backed by a mortgage. Meaning, if WEX goes belly up, the secured debt holders will get their dues first. WEX will be paying 6.5% interest each year on these notes. The interest is paid twice a year in March and September. The notes will mature or come due in March of 2033. So it's a long-term debt. However, WEX has options to redeem, meaning buy back these notes earlier under certain conditions. The indenture also includes some restrictions on what WEX can do. For instance, they can't easily create liens, which are claims on their assets used as security for debts, without also securing these notes. Also, they can't merge or sell off all their assets without making provisions for these notes. WEX has the option to redeem these notes early, but there's a catch. Before March 2028, they have to pay what's called a make-whole price, which is essentially a fee for paying off the debt early. Also, before that same date, they can redeem up to 40% of the notes using money from certain equity offerings, but only if they leave at least half of the notes outstanding afterwards. After March 2028, they can redeem the notes at prices specified in the indenture. If there's a change of control triggering event, like a major takeover, WEX has to offer to buy back the notes at 101% of their value, plus any unpaid interest. The indenture also lists customary events of default. This means that if certain things go wrong, like WEX fails to make payments, the noteholders can demand immediate repayment of the entire debt. Now, let's switch gears to the amendment to the existing credit agreement. This amendment allows WEX to borrow an additional $450 million through the incremental term loan B3 facility. This loan is set to mature in March of 2032, just a year before the other notes come due. The interest rate on this loan is based on SOFR plus an additional percentage or alternative benchmarks. WEX can pay off this loan early, but there could be a penalty. Specifically, if they do a repricing transaction within 6 months, they'll have to pay a 1% premium. The incremental term loan B3 facility is guaranteed by some of WEX's subsidiaries, and it's secured by substantially all of the assets of WEX and those subsidiaries. The Seventh Amendment also changes the consolidated leverage ratio. That's how much debt they have compared to how much money they're bringing in, from 2.75 to 1.00 to 3.50 to 1.00. This gives WEX more flexibility when it comes to making restricted payments. Okay, let's take a quick look at some of the documents attached to this report. There's the indenture agreement, which spells out all the details of the new notes. There's also a copy of the form of the notes themselves. And finally, there's the Seventh Amendment to the credit agreement with a full copy of the amended credit agreement attached. So what does all this mean for WEX? On the one hand, it's a bit of a gamble. They're taking on a lot more debt, which means higher interest payments. On the other hand, they're using that debt to buy back their own stock. If WEX believes their stock is undervalued, this could be a smart move in the long run. It reduces the number of outstanding shares, potentially increasing the value of each remaining share. They are also freeing up cash by extending some of their due obligations, which will allow them to pursue other initiatives, while taking a bet on interest rates not rising too high too quickly. What could be some of the risks? Well, if WEX's business doesn't perform as expected, they could struggle to make those debt payments. Also, interest rates could rise, making the debt even more expensive. And of course, there's always the risk that their stock buyback doesn't pay off if the stock price doesn't increase. Overall, WEX seems to be making a bold move to reward shareholders and restructure its debt. Whether it pays off depends on their ability to execute their plans and the overall economic environment. Thanks for watching. If you found this helpful, please like, comment, and subscribe for more deep dives into the world of corporate finance.